I'm Joseph Kim. In this week's Video Insights, I will look at Costa's most recent trading update, as well as the outlook for the business going forward. Last week, Costa entered a trading halt prior to alerting the market of a significant earnings downgrade, as well as its intention to raise equity to pay down debt. Those who follow the blog will know I've written about Costa in the past when I looked at its share price derating following its 2 earnings downgrades. However, it appears cyclical and structural impacts have had an even greater impact on Costa than alluded to at its August result. The list of issues appears to be impacting all of Costa's product categories, which include demand and pricing issues in mushrooms, dry and hot conditions impacting the citrus fruit size as well as the yield, along with higher water costs due to the drought, pricing pressure in blueberries due to higher industry volumes, and finally, a hail event impacting avocado crop volumes and lower than expected fruit sizing, which has impacted prices. The financial impact has been a $40 million or 30% downgrade to its prior EBITDA guidance of approximately $140 million for 2019. It also implies the second half EBITDA was just $16 million compared to $35 million in the December half last year and $61 million in 2017. What is worrying is Costa's earnings have declined despite increasing capital investment to grow production. Aside from the temporary supply and quality issues stemming from the drought, there appears to be a reduction in pricing in key product categories as a result of new supply, which is partly due to Costa's own initiatives at increasing capacity. This is perhaps most notable in blueberries, where Costa has more than doubled production over the past 5 years, despite having over 70% market share in the category. In fact, Costa's decision to accelerate the closure of aged mushroom production appears to acknowledge the potential negative price impact arising from new expansion. For 2020, Costa is forecasting a bounce back in EBITDA to $150 million, which assumes a moderate improvement of drought conditions and a more normal season and crop cycles. There are a few assumptions to be aware of here, including lower mushroom volumes as Costa looks to optimize its production network ahead of the Monarto commissioning in South Australia, 2020 being a citrus off-season, so there is no bounce back in volumes expected in 2020. Construction is pausing on the 10-hectare glasshouse expansion project in tomatoes, which pushes back the expected earnings contribution to 2021, and finally, Morocco returning to a normal year of production. While it is fair to assume some of these weather issues may reverse, any improvement will likely benefit the industry as a whole, which could impact pricing given the perishable nature of the product. The exception to this is in citrus, where approximately 75% of Costa's produce is exported to Asian countries. One thing that is clear from the recent Costa Group experience is the need to test assumptions underpinning earnings forecasts when making investment decisions. This is especially true for a company with as many moving parts as Costa. Thanks for watching, and remember to follow us on Twitter and Facebook.